So, so the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession.
Jim Rickards' dire warning about an upcoming recession sends shivers down the spine of even the most seasoned of investors.
So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
Get ready to buckle up as financial expert Jim Rickards sounds the alarm on a looming recession that could shake the global economy to its core.
The global economy is weakening very quickly. That's backed up by a lot of metrics. Most recent data out of China indicates they're on the brink of a recession, if not in a recession, which is kind of shocking considering this was an economy that grew at 10% compound rate for about 30 years. But right now, we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse.
According to Rickards, the Federal Reserve's efforts to stimulate the economy may actually be exacerbating the problem, setting a stage for a potentially catastrophic economic downturn.
We're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41, actually it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode.
As the world continues to grapple with the economic fallout of the pandemic, Jim Rickards warns that disinflation and deflation may be lurking just around the corner.
They're raising rates and inflation's coming down. That's clear. But what they don't know is are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have, and this is going to be part of what throws the economy into a severe recession. So that's kind of what the Fed's doing and how they think about it. Now, let's go to our next Irish storyteller. This is the market, and in particular, although here we had probably a distinction between the stock market and the bond market. The bond market's a lot smarter. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo, that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. It's going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of the NASDAQ, the turnaround actually started in November 2021. So we're down from those levels, maybe reach some moving average, but we're nowhere near the old highs. But that it could easily go down 30%. We know enough right now to know that number's going up this spring, but that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect. That unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, by the way, Adam, you mentioned wages or the salaries. That one, I just shake my head. Everyone was like, well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years, because they runs around 5% annualized. give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. Although, if you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. Well, so how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of the hat, played all their cards? And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar, the crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it, again, we've seen it all before, but you have to kind of take the timeline out to, 1,000 years, or, the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves. But what does it mean if $1 trillion worth of bonds show up, and the banks delivering the bonds say, give us the cash? Where does the cash come from? The Fed prints it. So now you're going to expand base money by perhaps $1 trillion or more at a time when you've been pretending to reduce base money. So this completely blows up their monetary tightening. Okay, they're not cutting interest rates. That we'll see what happens there. But they are increasing the money supply by, again, estimate upwards of $1 trillion. So what happened to your inflation fighting? What happened to your monetary tightening? And they just want to pretend. I mean, you do have to be expert to understand all these mechanics, but they're not that hard to explain. I mean, you can just say it in plain English, which is what we're doing. But from a policy point of view, it completely blows up their monetary tightening. But what happened was, the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up, or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I say, I lived through the 70s, where, hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that that cost push inflation. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not, and the yield curves are not sloping or upward sloping. They're inverted. They're going down. That tells you that, and we also see this in inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, yeah, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, I'm sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for that. So, even Jay Powell said the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing, but that's not priced into markets. The markets are kind of pricing in a squishy landing or a soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. Because the inflation is pretty bad. In other words, they've set out on a path. Also, I'm speaking about the U.S. Federal Reserve, the Federal Open Market Committee, but the ECB is right behind them. I mean, the ECB has said they intend to raise interest rates in July. Well, that's a big deal. They haven't raised them for years, and they're not only at zero, they've been negative. So to raise them at all and go from negative to even positive, even 25 basis points, which is not a lot relative to what the Federal Reserve is trying to do, but it's kind of an earthquake in Europe. But that's all because of inflation. They're trying to snuff out inflation. So the balancing act, the question, of course, is, okay, we know that you can kill inflation if you raise interest rates high enough. Paul Volcker did it. He killed inflation, but it was 21% interest rates. I still remember my first mortgage. I bought a condo in New York City. The mortgage was 13%, but inflation at the time was 15%. So my real cost of borrowing was -2 before tax benefits. It was more like -7 after tax benefits. So it was actually quite a good deal at 13%. But that happened. But that was part of how Paul Volcker beat inflation in the early 80s. So you can do it. But from current levels, which are over 8% in the United States, but even Japan's up around 2 or 3%, again, which is sky high for Japan. Japan's a country that's been in, we used to talk in the early 2000s about the lost decade. Well, now we're entering our fourth lost decade. They've had 30 years of very little growth. And I checked it out the other day. Since the market crashed at the end of 1989, and it was a multiple market crash, it was stocks. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. And I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. We do not have demand pull inflation. We don't. This is not what's going on. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, which is, again, when I talk about in the book, it's real, prices go up, but it's self-negating. You know, the old saying that, you know, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how cost push inflation, tips into a recession, and then prices come down.